Welcome to TalkTickers. We're your shortcut to being genuinely well-informed about earnings calls. Today, we're diving deep into the third quarter 2025 results for UNI Corporation. We've sifted through the call, pulling out the important nuggets for you.
Yeah, it's an interesting one. A company navigating what sounds like a somewhat cautious economic environment, but they're still pushing forward with some key strategic moves. We'll explore what their latest numbers really tell us about performance and, where they might be headed.
Okay, let's start with the headlines then. Give us the snapshot. UNI Corporation reported consolidated revenues of $610.8 million for Q3 2025. That's up, 1.2% year over year? Seems pretty modest.
It is modest growth, yeah. But what's fascinating, or maybe revealing, is under the hood. While their consolidated operating income actually dipped slightly to $48.2 million, their net income went up. Came in at $39.7 million, or 2.13 cents per diluted share.
Up, interesting. And adjusted EBITDA.
That was up too. Reached $85.8 million. And for anyone maybe less familiar, adjusted EBITDA gives a clearer view of operational profitability before certain costs like interest, taxes, depreciation.
Right, strips out some of the noise. So management said these results were largely in line with their expectations. What does in line really signal here, especially given, the broader market conditions?
Well, it mainly tells us they're hitting their internal targets, which is crucial in any climate, really. They definitely emphasize making progress on gross margins and just better operational execution. So controlling what they can control.
Okay, controlling the controllables.
Exactly. But the real story, I think, is buried a bit deeper than those headline numbers.
Absolutely. Let's dig into those specifics then. Management's insights is where it gets interesting. Core laundry operations, what happened there?
Right. So core laundry revenue, that grew just 0.9%, $533.2 million. Organic growth was slightly better at 1.1%. Now, the operating margin for core laundry did slip a bit, down to 6.9%.
Okay, a slip there.
But, and this is key, the adjusted EBITDA margin held steady, unchanged at 13.5%.
That's a really important distinction.
Yeah.
Can you unpack why that stability in adjusted EBITDA margin matters so much, especially when the operating margin itself declined? What's that telling us?
It's pretty significant, actually. It points towards strong underlying operational performance, managing the actual business well. A drop in operating margin might suggest revenue pressure or rising direct costs, which isn't great.
Right.
But when adjusted EBITDA margin stays flat, it suggests management is effectively controlling those key operational costs. They specifically mention favorable trends in merchandise costs and plant production costs within core laundry. Shows real discipline there.
Discipline that sort of offsets maybe some of that top line pressure.
Yeah.
Makes sense. Okay, beyond laundry, what other segments should we be looking at?
Well, there's the specialty garment segment. That's the nuclear decontamination and clean room services. They hit $47.8 million in revenue. The operating margin there, 22.8%. That can bounce around quite a bit.
Why is that?
It's really the nature of the business. It's more project-based. Sometimes seasonal demand plays a role. So less predictable than core laundry.
Gotcha. And the first aid segment, that one really jumped out at me on the report. Revenue's up 9% to $29.8 million. Mostly from their van operations. That seems pretty strong.
Oh, absolutely. It's a definite bright spot. That 9% growth, and particularly what they said was mid-double-digit growth in the van operations, that shows real momentum.
So what's the strategy there? Just sell more kits?
It's more than that. Management sees a big opportunity, not just adding new customers, but penetrating their existing customer base much deeper. Think broader services, safety training, offering AEDs, fire extinguisher certifications, things like that.
So moving beyond just products into comprehensive safety services.
Exactly. It leverages their existing relationships. It's a clear strategic play.
That's a smart shift. Okay, speaking of strategy, what about the broader picture? Investments, guidance for the year?
They're definitely investing, putting money into people, technology, infrastructure. They were clear these are aimed at long-term growth and profitability. And, these things take time to fully pay off. They acknowledge that. Right.
Long-term plays.
Yeah.
And despite those investments, they kept their annual revenue guidance the same, $2.42 billion to $2.432 billion. But, and this caught my eye, they increased the diluted earnings per share guidance, now $7.60 to $8. Why bump up EPS guidance if revenue guidance is flat? What's the lever there?
Yeah, that upward EPS adjustment is definitely noteworthy. It seems to be largely driven by a change in how they're accounting for costs related to key initiatives. They now estimate those costs at $7.5 million for the fiscal year, down from $12 million previously.
Okay, lower costs, higher EPS. Makes sense. But why the lower cost estimate?
Well, a key reason they gave is that a higher percentage of certain costs, especially related to their big ERP system project, are being capitalized now rather than expensed immediately.
Capitalized. Okay, for those of us who aren't accountants, break that down. What does that mean practically, and why does it boost EPS like that?
Good question. So when a cost is capitalized, it basically means it's treated as a long-term asset on the balance sheet. Think of buying a big machine that'll last for years. You don't charge the entire cost of the machine against one quarter's profit.
Right. You spread it out. Depreciation.
Exactly. So similarly, if these big ERP, that's Enterprise Resource Planning System upgrade costs, are viewed as long-term investments, creating future value, they can be put on the balance sheet and expensed gradually over time. This means less expense hitting the income statement right now, which directly boosts reported earnings per share in the current period.
Ah, okay. So it improves the reported EPS number.
Yeah.
But it's more about accounting treatment than, say, selling more stuff this quarter.
Precisely. It's an important distinction for understanding the quality of the earnings beat, so to speak.
It's incredibly important. Okay, let's pivot then. What does all this mean for you, the investor listening? Connecting the dots to the bigger picture. What's the overall demand environment actually like for you and I right now?
Well, management's own word was somewhat cautious. They noted seeing some targeted reductions in employment levels, particularly in manufacturing sectors they serve.
And that hits their wear levels, fewer people needing uniforms or first aid.
Exactly. It puts a damper on top-line momentum, makes it harder to grow revenue quickly.
So you've got softer demand, and they also mentioned the challenging pricing landscape. That sounds like a tough combination for revenue growth.
It definitely is. Even though they mentioned solid new business wins and better customer retention, it seems like they're fighting headwinds to grow the top line.
And what about tariffs? That's always lurking these days.
It's certainly a theme. They said they're not seeing significant direct headwinds yet, but they are seeing vendors start to increase prices because of their own increased sourcing costs, likely linked to tariffs or supply chain shifts. And UNI foresees potential for more increases down the line.
But the company thinks their supply chain diversification over the past few years helps them here.
Yes, they seem pretty confident that those efforts have positioned them reasonably well to navigate this fluid tariff situation. That foresight is definitely valuable.
Okay, good. Beyond those external pressures, what about internal tech and operations? You mentioned the ERP project.
Right, that's ongoing. Currently in its second phase, more focused on finance, and they said it's progressing well. They also talked about ongoing benefits from their ABS, that's their asset-based system, which helps with merchandise control and road efficiency.
And I saw something about telematics. That sounds forward-looking, putting them in road trucks.
Yeah, that's interesting. Implementing telematics, including inward and outward-facing cameras on the trucks.
So tracking vehicle data, GPS, driver behavior.
Exactly. The goal is to use all that data to further optimize routes, improve driving safety, and ultimately boost efficiency even more. It's all about leveraging data.
Makes sense. And back to first aid for a second. We know it's growing fast. The strategy is broader services.
Oh, right. Penetrating deeper with existing customers, safety training, AEDs, fire extinguisher certifications. It's not just about the vans, it's about becoming a broader safety partner.
Yeah, transforming from just a supplier to a solutions provider. That builds loyalty, higher margins probably too.
Which definitely seems to be the goal.
Okay, let's talk balance sheet. How are they looking financially?
Very solid. That's a key strength. They have absolutely no long-term debt.
Zero long-term debt. Wow.
Zero. And they had $211.9 million in cash and short-term investments on hand. Plus, they're generating good cash, $196.5 million in cash from operations in the first 9 months of this fiscal year. Free cash flow, the cash left after expenses and capital investments, was up 22% to $86.7 million. Strong numbers.
So, a fortress balance sheet, strong cash flow. Sounds like they have plenty of firepower. Are they using it?
They are. They spent $109.8 million on capital expenditures, investing back into the business. They also bought back $25.6 million worth of their own shares.
Okay.
And they made a few small acquisitions for small first aid businesses for about $5.4 million total. So yes, deploying capital across different areas, they clearly have flexibility.
Good to see. Any one-off items we should be aware of that might skew the numbers?
A couple of things worth noting. They had a $2.8 million gain from selling a non-operating property. That boosted net income and EPS, but didn't flow through operating income.
Right, not core operations.
So correct. And they also incurred about $5.7 million in expenses related to some strategic advisory costs, probably left over from prior discussions, and an ongoing legal matter.
Okay, and labor. Any issues there? Lots of companies are struggling.
They reported a pretty stable environment, actually. Labor costs were apparently largely consistent. They even suggested that improved stability in their workforce has led to benefits like less overtime, lower turnover, and just better overall efficiency. So a positive sign there.
That is a good sign in this environment. Okay, we've gone pretty deep into UNI Corporation's Q3. Now let's shift gears. It's time for the segment where we explore the bold, maybe unconventional, but surprisingly plausible. Remember, this is absolutely not financial advice. Just some food for thought, maybe straight out of a hypothetical analyst's slightly crazy pitch book.
All right. So let's consider UNI's situation. You've got that fortress balance sheet we talked about, zero long-term debt, over $200 million in cash. You've got consistent free cash flow generation. And you have management clearly stating they want to expand their high-growth first aid segment.
Okay, I see where this might be going. You put all that together. What if? What if they did something really aggressive, like a highly leveraged recapitalization? Imagine you and I taking on, say, $1 billion in debt. $1 billion. Solely to fund a massive acquisition spree. Just hoovering up smaller regional first aid and safety service providers. Go big or go home in that segment.
Exactly. It sounds wild, maybe, given their conservative history, but think about it. It would instantly turbocharge growth in their most dynamic segment, first aid.
Yeah.
They could plug these acquisitions into their existing operational efficiencies and, through financial engineering, drastically increase earnings per share.
All while the core laundry business just kind of steadily navigates that cautious spending environment you mentioned.
Precisely. It's a high-octane bet. Leveraging that, frankly, under-leveraged balance sheet to consolidate a fragmented but growing market. It could fundamentally change how the market values the company, shifting the narrative towards growth. Plausible, maybe. Bold, absolutely.
Definitely food for thought. Okay, that wraps up our deep dive into UNI Corporation's Q3 2025 earnings call. We saw a bit of a mixed picture, didn't we? Solid operational execution, clear strategic investments.
Right. But alongside those external headwinds, cautious demand, some pricing challenges, I think the key takeaways for me are that very strong balance sheet, giving them options. The focus on tech like ERP and telematics for long-term efficiency gains. And, of course, that exciting growth trajectory and strategic push in the first aid business. That feels important.
Absolutely. Remember, this deep dive is designed to give you those key insights, the context you need to be genuinely well-informed without drowning in jargon. As always, this is an investment advice. Please do your own due diligence.
And maybe think about this. How might UNI's ability to hold margins and even boost EPS in this cautious climate reflect a broader resilience, perhaps, in these kinds of service-based businesses? And could their strategic pivot in first aid, moving from products to solutions, foreshadow similar moves by other companies trying to deepen those customer relationships? Something to consider.
Great points. Join us next time for another deep dive into the numbers that matter.